Have you always had that view that it's not quite as valuable as, say, the cash flow? Or is it
Yeah,
is it the you saying the adjustments creep into accounts more and more, or have they always been there?
no, they've crept in more and more. You've
Have
got
they?
this, we call it fairy tale adjusted EBITDA that people come out
Yeah.
with all the time. I mean, EBITDA itself is almost fairy tale, but when you talk about adjusted or underlying earnings, there are so many adjusting items.
Hmm.
And the companies presenting their results typically point us towards the things that they would like us to read, not the things that investors should be reading. Very few businesses, for example, mention return on capital. Very few of them discuss that. Some do, and that's great. Hats off to them. But
The ones who have good return on capital
yeah,
probably.
who think that's a relevant thing to talk about, which of course it is. You invest based on the potential capital return. There's no point investing otherwise if it's not going to deliver eventually a decent return. So yeah, things have changed in our opinion. Some businesses are very good, and we're going to mention one going forward, but a lot of highly acquisitive ones just keep acquiring, and sometimes we question whether there has been an eye on the potential return on capital from their acquisitions.
Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello, Chris. Good to see you again.
Hi, Lee. Good to be here as always.
So the theme of this episode is going to be around acquisitions and do they make sense? And we're going to share multiple examples of companies where that has made sense and where it perhaps hasn't. And as always, we've got a couple of good companies for you to take a closer look at. But first of all, as we always do, we're going to start off with a bit of news. And there's been an interesting bit of analysis done by Hargreaves Lansdown on early bird investing, particularly into ISAs. Chris, do you want to take it away?
Yeah, it was a stat out from Hargreaves Lansdown, really a big broker, has got loads of clients. So when they give you numbers like these, they're quite interesting because they have such a huge universe of clients. And their research is indicating that it's been a good idea to put your ISA money in at the very start of the ISA tax year, 6th of April, as near as you can to the 6th of April. They've run the numbers, and over a decade, if you put your full allowance in every year on the first day, they would have grown to £360,500. This is assuming they've been invested in an index tracking fund, an international index tracking fund. So 360,500 if you put them in the first day of the tax year. If you'd left it till the last day of the tax year, same amount, maximum, it would have ended up as 322,500. Clearly, that's a big swing. Even if you'd staggered investments evenly over the entire year, you'd have ended up with 343,500. Between your maximum 360,000 and 343,500, you'd have still made circa you'd have been £17,000 better off if you'd have put your money in at the beginning of the tax year. So it's shut your eyes, shove it in as soon as possible and hope for the best. But that's over a 10-year period investing in an index tracker fund.
That's a lot of money, that to return, isn't it? It really is just by
Yeah,
investing at the
that's
start of the tax year. You mentioned there as well, that was based off an index, international index tracking
yeah,
fund.
yeah, that's the important point there.
That's
Yeah,
the
look at those
important point
their
there.
returns as well, yeah.
Yeah, because we're talking about brokers, Peel Hunt has just also released a bit of news that the FTSE Small Cap Index will cease to exist if the trend continues. It's a pretty serious, quite a bold statement, shall we say.
Yeah, Peel Hunt, corporate brokers really going for it. It made a fairly damning statement about small caps and AIM, how they're in a doom loop a few months ago, and it's continuing the theme. It put out this statement that it doesn't seem the full FTSE small cap index would exist. It shrunk from 160 companies at the end of 2018. This is excluding investment trusts, to only 114 in December 2023. That's a big move. And the value has declined even more. Combined market capitalization is 29.4 billion. That's half of its 2018 peak of 57 billion. You can see this transferred to AIM as well. AIM index, the junior index, the growth index, has seen its value shrink from circa 150 billion across 852 companies to only 76 billion across 742 companies at the end of February. And Peel Hunt makes a point of where are the new companies coming to populate these indices. AIM in particular has struggled, but the small cap even more. And some small caps have come down to AIM. So they've fallen off the small cap index into the AIM index, but then AIM subsequently has seen so much takeover activity. I mean, the other point that some people are making of a cut in stamp duty, could a cut in stamp duty help the smaller index? Could it help the UK market? Stamp duties charged about 0.5% on purchases of equities, not on AIM shares, but on main market stocks. So it would help small caps. I'm not so sure. I think the problem lies with the interest in the companies. They've got to be more interesting businesses, and just a notional 0.5% cut in stamp duty is really not going to go very far, in our opinion.
What do you think would have more success in terms of what the government can and can't do? A tax break for investors to invest in small AIM-listed companies, or a lowering of the corporation tax for newly listed companies for the first 5 years? What do you think would have a greater effect?
I think the things could be better at the company level. So a lowering of corporation tax. And corporation tax got quite high now, 25%. So pull it back against where it was, get it back to 19%. That's going to clearly be attractive. Businesses are going to make it greater returns. Encouraging other reliefs, other tax reliefs to get into smaller early stage businesses. Extend those reliefs to slightly larger companies. I think I pushed before to make it available, up the reliefs for companies that even, slightly larger than they are at the moment. I think that would be really helpful. So most things at the company level. But companies have also got to do their own bit. They've got to promote themselves in a good and accurate way and not overdo things, but report as well. Report their results in a clear and accurate way that people can understand. And we're going to go on and discuss a company that I think fails in that regard. But I just think that there needs to be more self-help. You just can't rely on government. The businesses themselves have got to be more interesting. And there are a lot of interesting companies out there. They don't do enough to promote themselves. They don't do it in the right manner anyway, in our opinion.
Yeah, as we always talk about in this podcast, there are a couple of companies we're going to come on to as well later on that are of interest. But I mean, I do agree with you. There is that element of self-help. You've got to take the bull by the horns. But I do think the government could do more at the company level. If you incentivize at the company level, especially for new to the market, IPOs, etc., then that in turn would probably attract investors instead of trying to work at the investor level, which
at the index level. Oh no, I agree with you. I think there's too much talk about propping up an index. That's wrong. Who cares about the index in a stock market if there aren't decent, attractive companies to invest in? The companies themselves have to be more appealing, and if there are tax breaks at the corporate level, that should be helpful.
Yeah. And one of the reasons why we're losing companies is private equity. But according to consultancy firm Bain & Co., they've got 28,000 unsold companies worth $3 trillion.
Yeah, people forget about this. Private equity funds companies, but it also has to offload them at some point. And when there is not a willing appetite among equity investors, this de-equitization that people talk about, how they are offloading them. What they're starting to do is, because they can't find buyers, they're creating what some are calling, and not just one person, I think, calling a sort of pyramid scheme. They're creating other private equity groups are buying out. They're buying out from each other. So quasi-pyramid schemes developing, or launching new funds that are buying businesses from their previous funds, which isn't a healthy environment. Really, it really isn't. At some point in time, these businesses have got to be really released by the private equity into the outside world to other owners. And it's really building, there's a bit of a bubble building there. So you've got it at both ends. Yeah, it's all private equity would like these businesses to be listed or somebody else to buy them, but the only people that buy them are private equity. And sometimes the same funds with the same private equity group but another fund vehicle. It's absolutely crazy.
Yeah, I agree with you. It does sound absolutely crazy. And perhaps as well, maybe what also is crazy is gold is at all-time high and oil is near a 6-month high as well. So I don't think this bodes well for inflation or for interest rates coming down. What do you think?
And this is, I find, slightly worrying. The stock markets have been going up. Price gold has also been going up. It's set at over 2,288 per troy ounce. That's dollars. Typically, safe haven, people rush there where there are concerns around the world. There are clearly concerns in the Middle East at the moment, which is also pushing oil prices up to $91 a barrel. And people are talking that up now. That could be over $100 a barrel. Clearly, a rising oil price isn't going to help inflation either. So there's more pressure there as well. So both two aspects that sort of contradict a little bit what's been going on in equity markets.
another thing to add further to the inflationary is the US job numbers have just been released, which were quite positive.
Yeah, unbelievable. The US economy is absolutely flying. Added 303,000 jobs in March compared to the expected 200,000 and 275,000 in February. And clearly there is pressure as a result of all these job take-ups, there's pressure now on wages, which obviously fuels inflation again. So maybe we'll have to wait until 2025 for interest rates to come down, at least in the US. And typically the UK generally follows the US, which is going to be quite tough for many people.
Yeah, if you look at those things and connect them, US job numbers doing well, you've got price of oil, price of gold, then yeah, it doesn't look great for interest rates coming down, does it? So,
No, it doesn't. It's a lot of pressure there still. It's not easing. The heat isn't coming out of the economy at all in the US. It's doing pretty well.
should we drill it down now to a couple of stocks, particularly in the US, starting with Google?
Yeah, one of our ultimate stocks, Google, is going to consider charging for its AI-powered search. This is massive. Google doesn't charge for anything, not in its traditional business. It charges for, obviously, its cloud computing, its B2B stuff, but not for search. And it's considering a new premium features powered by generative artificial intelligence. And I think this is the sign of things to come. The amount of money that is getting poured into AI, somebody has got to pay for it eventually. And it isn't going to be advertising based. Somebody's going to have to pay a subscription like they do for other things. And Google's mentioning this now. Microsoft are already charging for their Copilot added feature as well. So all this AI is going to have to be paid for. And it's going to be interesting how Google prices this and what the take-up's likely to be.
It's interesting as well, isn't it? Because if the AI-powered search is meant to be the next evolution of the internet search, Google search, as it's become known, how does that level the playing field across the globe for those that can't afford it?
Yeah, it's true. They're even saying, Google, even though you're going to be paying here, you're going to still have ads as well with it. So there will be ads.
They're having the cake and eating it.
They're doubling up.
They're doubling up, yeah.
But since ChatGPT has been added to Bing, Microsoft, the thought was that, wow, it could be a threat to Google. Apparently it hasn't mattered a jot. Yeah. Google's search is still all dominant and Bing hasn't really dented their market share at all. But yeah, it will be interesting if people are going to pay. Google, it's always amazed me how much Google provides for nothing anyway.
Because people are so used to searching for free, I wonder how much people will be able to transition to paying for something that they've very used to just searching for free.
Yeah, it's true, but it's going to have to, the penny's going to have to drop at some point. Yeah. And there's too much free stuff out there. Too much free content, media groups, loads of free stuff.
Yeah. Unless traditional Google search suddenly becomes not as good as it used to be.
Well, pushing you towards the premium one as well. Yeah, it's going to be an interesting one. Watch this space.
Interesting, yeah. And another one of the ultimate stocks portfolio, Walt Disney. That seems to just constantly have battles all over the place. What's going on there? What's going on with Walt Disney?
Yeah, it's been bonkers time at Disney. It seems to have battles all over the shop. The CEO came back, Bob Iger, massive reputation, but activist shareholders didn't like it. They wanted Disney to really knuckle down and tidy things up, focus on its core areas. And there's been a huge proxy battle with these activist investors. And finally, Iger and his Disney board have sort of won. All the boards and Iger's preferred nominees have been accepted. And Iger's Tryon Peltz has gone off with a tail between his legs. Although they still made a lot of money out of it because Disney shares have popped up. This activism has helped them a bit. But in the end, Iger got over the line through the support of Walt Disney and his brothers Roy's descendants, the heirs, and also Star Wars creator George Lucas. So all of the sort of Disney supporters, the core Disney supporters of old, came on Iger's side and helped the vote get over the line. But yeah, it's been just going on forever, this thing.
So should we move closer to home? UK companies?
Yeah, for those that follow our Income Boosters portfolio, we put out a big quarterly update. Our Income Boosters has a 5.9% average dividend yield, and many of the companies are trading at very attractive valuations. So look on the site, you'll see an update from the Income Boosters portfolio. Those income seekers among you, income seekers these are only UK stocks, so it's directed at UK shareholders. But yeah, you get a very nice dividend yield, comfortably above the FTSE, which is averaging about 3.8%. Unfortunately, the income boosters itself, the capital, the overall return in the quarter was mildly negative. There was one big loss position, a company that we sold. We've got the portfolio's got out of. But other than that, the rest of the bunch, a lot of them did reasonably well. But yeah, income seekers, look for our income boosters portfolio.
We're going to move on to some UK small caps. In particular, we're going to look at FUTR, why it's so cheap. But just before we move on to that, we talk about PE ratio. You talk about PE ratios quite a lot. And it might be nice just to share with the audience, for the new ones to invest in, what is the PE ratio and why is it important? Or perhaps why it's not important? Should investors take a keen interest in the PE ratio?
It's interesting. It's an oft mentioned measure of valuation, the P ratio, and it means the price earnings. It's the price of a share divided by either the historic or the future forecast earnings of the share. And typically a high PE ratio suggests a company that it's going to grow its earnings and its profits very fast. The low PE ratio suggests a company that is X growth and it's no longer growing fast, and therefore is not expected to have much earnings growth. And a lot of people are fixated by the P ratio. They only invest based on P ratios. That's not only invest on them, but that is a key criteria for their investing process. They think, oh, the P ratio is too high, I'm not going there because it's too overvalued, or if it's too low, one thinks that it's not growing at all. He wants to buy into an ex-growth company. Many years ago, I gave a talk highlighting the perils of the P ratio. And since then, we've seen many highly rated, high P ratio companies perform staggeringly well. Just because the ratio is high, the earnings can grow even faster than the forecast suggests. NVIDIA is one example. The chip company that's at the heart of the AI revolution. NVIDIA has quite a high P ratio, but it's grown into it. It's growing very fast. And the other problem, the P ratio, is what you're looking at in the E, the earnings. And without going into too much detail, earnings are really ambiguous. Some companies forecast earnings, and the earnings they report are full of adjustments. So you can't rely on them. If you look at the real earnings, they're a million miles from the adjusted earnings. Other companies are very genuine in their reporting. For example, Alphabet, owner of Google, doesn't adjust anything at all. Microsoft is also very fair in its earnings reporting. Whereas a lot of small growth companies, a lot of those on AIM that we look at, the earnings are almost irrelevant. They're so awash with adjusting items that they're meaningless. And for that reason, we just generally focus on the cash flow. So the P ratio in a nutshell should be just one criteria of your investment assessment. Just because it's got a staggeringly high P ratio doesn't necessarily mean it's overvalued, because it could be growing incredibly quickly, and its long-term growth profile could be absolutely fantastic. So yeah, don't be fixated by the P ratio. That's our recommendation.
For someone who's invested for 20 plus years, 25 plus years.
Yeah.
I don't want to show you. I don't want to show your age here.
Yeah, plenty
Chris.
more than that.
More than that. 30 years.
Yep. Yeah.
Have you always had that view that it's not quite as valuable as, say, the cash flow? Or is it the adjustments creep into accounts more and more? Or have they always been there?
No, they've crept in more and more. You've got this, we call it fairy tale adjusted EBITDA that people come out with all the time. I mean, EBITDA itself is almost fairy tale, but when you talk about adjusted or underlying earnings, there are so many adjusting items. And the companies presenting their results typically point us towards the things that they would like us to read, not the things that investors should be reading. Very few businesses, for example, mention return on capital. Very few of them discuss that. Some do, and that's great. Hats off to them. But
the ones who have good return on capital,
who think that's a relevant thing to talk about, which of course it is. You invest based on the potential capital return. There's no point investing otherwise if it's not going to deliver eventually a decent return. So many businesses seem to have that as the below down on their list of priorities, and that's something that you can only really be judged now based on cash flow, free cash flow as well. So yeah, things have changed in our opinion. Some businesses are very good, and we're going to mention one going forward, but a lot of highly acquisitive ones just keep acquiring, and sometimes we question whether there has been an eye on the potential return on capital from their acquisitions.
Yeah, interesting. So perhaps maybe this adjustment culture has been creeping in more and it's diminished the value of the PE ratio. Would that be a fair summary?
Yeah, it has. I totally agree. And it's something that a lot of people are getting fed up with. They're getting fed up with adjusted EBITDAs.
Yeah.
I mean, it's absolute rubbish. The late Charlie Munger, the late great Charlie Munger, Warren Buffett as well, two great investors. They think it's rubbish as well, but people keep spouting it out. And it's, they just need to lose it and focus on real numbers and typically the cash flow and real cash flow.
Should we move on to some companies?
Yeah. Let's go on to have a look at some small caps that we've looked at this week. They've been reporting.
Yep, Future. Why does it look so cheap?
Oh, it's bizarre, this. I think Future owns a huge number of media brands or magazine brands, websites across the numerous sort of interest areas. It owns Money Week now, and The Week. It owns Country Life, I think, or Country Homes, and all sorts of magazines. And it acquired Go Compare, the financial products comparison site. It acquired them for quite a lot of money, 590 odd million in 2020. But yeah, Future, based on its P ratio, looks really cheap. Trades at under 6 times earnings. So clearly there are doubts around the earnings. There's somebody suspicious about earnings. But however, look at the cash flow of Future, and that's pretty attractive. Last year, by our reckon, it generated free cash flow of 160 million. That's all the cash, its operating cash flow, less its capital expenditure. But again, going back to the adjustments, Future also managed to adjust its cash flow. As I said, by our reckoning, we estimated its cash flow, we added up to be 159, 160 million pounds. But Future's presentation was 253 million pounds of free cash flow. Future, conveniently, in its free cash flow, ignores the interest it paid, which is pretty hard cash in my book.
Yeah.
And also the tax it's paid. And tax is about as hard a cash as you can come. So its free cash flow that it presented in its headline numbers ignored those two key items.
Last time I checked, you've got to pay them, haven't you? There's no getting around them, is there?
You've got to pay them. They're definitely cash. Of all the things that are most definitely cash, tax and interest are definitely cash.
Yeah.
Is definitely cash. So yeah, I would say there's a lot of distrust in its reporting, and the reporting is so full of marketing management speak. I would urge people to have a look at their investor relations section of their website and to fully understand what their strategy is based on how they're communicating it. But so for a communications and media company, they're in our book not communicating very well. But yeah, notionally, even if you allow worst case free cash flow, the shares look really cheap. Is the future, excuse the pun, not quite as rosy as maybe people think? That's the problem with this business, is its model somewhat broken.
So the PE ratio is approximately around about 5 or 6, but does that represent value, which is traditionally what the PE ratio used to meant, isn't it? It's
so that's adjusted. That's based on adjusted forecasts.
Yeah.
What are the real numbers? Also, it's also telling you growth is really ground to a halt. This business grew a lot through loads of acquisitions, typically funded by debt as well. Debt's got more expensive. Where's the growth going to come from now? They got loads of publications. The advertising market's very much on the floor at the moment. Where is it going to grow? How's it going to grow now? Yet more acquisitions? What's it got in its locker of actually innovation and development to change things to help it to grow again organically?
We're going to come on to a couple more companies that have done acquisitions, but do you think it would be a fair comment to say that quite a few UK companies over the last few years have relied on an acquisition strategy for growth, which in and of itself isn't a bad strategy, consolidating a fragmented sort of marketplace. But that's off the back of traditionally cheap money, isn't it? So as cheap money's now come to an end, these growth strategies are all coming to an end as well, aren't they, do you think?
I think acquisitions are fine and they work. They're not easy. I don't know how some businesses do acquisition after acquisition. We mentioned one a few weeks ago, Marlowe Group, the so-called buy and build strategies, made countless acquisitions. I'm not sure at the end of the day what real value has been added. It's offloading a lot of the acquisitions it recently made. Some companies are good at it. Alma, a UK main market stock, has had a history of acquiring companies and done it pretty well. But many businesses, I think, struggle. And from our perspective, acquisitions should primarily be supported by internally generated cash flow, not by debt, and particularly not by debt that's gotten a lot more expensive, which makes the whole model far harder to deliver on if debt's very high.
And continuing with the acquisition sort of theme here, there's a couple more companies that, again, you're questioning their strategy. Gooch and Housego.
So Gooch Housego, I think it's a lovely little company. It's an AIM company founded in 1948 by Archie Gooch and Leslie Housego in Ilminster in Somerset. It's a lovely little business. It's a specialist manufacturer of photonic components and systems. And they go into all sorts of industries now, life sciences. And importantly as well, they've been supporting the chip semiconductor manufacturing companies as well. But this business, if you look back in its history, how it evolved. I look back, I think it was about 8 years. Back in 2015, it generated an operating profit of 10.3 million on revenue of 78.7. Margin was a healthy 12% operating margin. It had net nice chug, a load of net cash as well. Fast forward, it's made countless acquisitions, debt's risen as well. Now the reported unadjusted operating margins have dropped to, the last time we looked in 2023, they were 4.6%. Yeah, I know, I acknowledge that there are amortization costs in there you could disregard. But is this a better business after all its acquisitions? I'm not so sure. Its turnover is a lot more. It's nigh on double where it was. But that's just been all built around acquisitions. Organic growth seemingly has been non-existent. And this is a really nice specialist manufacturing business. I just wondered if you'd left the engineers to work creatively and look at things, how much better off it might be than it is now. And it's now, I read recently, it's offloaded one of its businesses that it probably acquired. It's under new management now. Hopefully they can get to grips with it, because it's the sort of company that UK should be supporting. So really interesting things, supplies into some key sectors. I just think it could hopefully, or I hope it could do hopefully a lot better than it has been. But the acquisitions haven't stopped. Even under the new management, they're making more acquisitions.
And what's your thoughts on Quartex Technologies, which has just written down 2.5 million for a company that it bought only a couple of months ago? What's your thoughts on that one then for an acquisition strategy?
That was bonkers. We've hold shares, our fundamental portfolios hold shares in Quartex. Nice company, telematics business, subscription business, never made an acquisition, not in my memory, not since it's been on the stock market. Under a newish CEO who took over from the founder who stepped down, it's made an acquisition, 2.5 million. 2 months later, the acquisition is clearly not worth anything. The founder's come back, the former CEO has been sacked, the CFO's gone now as well, and the founder's back in charge. I don't think he was even aware of it when they did this deal. Absolutely horrendous. How the loss of shareholder value for shareholders in such a quick time is absolutely dreadful. Absolutely awful.
It seems absolutely bizarre that they would buy a company for 2.5 million and then 2 months later just write that off as,
yeah.
It does seem very odd.
But AIM there are a load of companies on AIM. One of the nicest companies on AB Dynamics, a specialist engineer, grew fabulously organically for year after year under its former CEO. New CEO has come in and made 4 or 5 acquisitions, some of them quite costly. It's moved into a different area as well, from manufacturing and engineering, testing machines, to become an actual tester of cars. But this business has all grown organically. Its shares returned at their peak from IPO to a peak 3,100%. Since the acquisition mania, they've actually fallen about 40% down. But yeah, I just wonder, and I just wonder if it's lost its engineering innovation as well. When you a load of engineers doing great things, seeing all these acquired companies in all sorts of different sectors and areas, they're not going to be terribly incentivized, are they?
Have you been following the Boeing airline?
Boeing, yeah. Oh, yeah.
A common theme that I've come across in various different news and kind of documentaries I've watched on it, that they've lost their engineering way. They were fundamentally an engineering company that then transitioned into a corporation focused on the share price, to put it politely. Many previous employees have said that they're losing what they fundamentally were, which was an engineering innovative company.
It's so sad, because give it to people who have this innovative viewpoint. It should be great. AB Dynamics was doing great things, earning great margins. Hopefully we'll return to it. But it's a very different company than it was when it first joined the stock market. Some of its acquisitions look good, but it's just another case, I think, of acquisition mania maybe taking hold. And clearly, executives that inclined to acquire to make their companies bigger often get remunerated far better for a bigger company. So if you're managing a small company, CEO of a small company, your remuneration is probably somewhat smaller. However, if it's suddenly come a lot bigger and you do lots of deals, conceivably you try and justify a higher salary. Oh, it's great for you, but I'm not sure it's great for shareholders.
Yeah, I'm just curious here as well. AB Dynamics, that's in the fundamental portfolio, is it?
Yeah, yeah.
Yeah. So new management's come in. Did they have any history with the company, or were they brought in?
They came from, gentleman's come from an external company, another big FTSE 250 company where he was responsible for a lot of deals as well, a lot of acquisitions. The previous CEO hadn't made a single acquisition, and under his tenure largely, the stock was 30 plus bagged, so 30 times, listed at 14 million market cap. At one point it was about 600 odd million market cap. Only raised a relatively small in the end amount of external money, but that was all organic growth.
Yeah.
This company, driven by great engineering expertise and some really nifty products that were evidently well liked by the automotive testing sector. New guys come in from outside and adopted a different approach, seemingly.
And I guess if he's come from a FTSE 250 company with a predominantly acquisitive strategy, then he's naturally going to deploy that strategy
Yeah.
The board must have had that in mind, would you say that?
The founder still owns a huge number of shares, 20 odd plus% of the equity. So I assume he would have been in favor of it. The business has got bigger. Is it better? Not sure. Let's hope the acquisitions work. We're still holders across our portfolios. It's a lovely little UK engineering business in a specialist area. The transition to electric vehicles is really hot, all of which they need new testing. A lot of testing needs to be done. So hopefully it's going to work out. But I do wonder sometimes.
Yeah. What would be an acceptable timeline for it to work out? Or when do you think?
That's the irony, isn't it, behind somebody that's fixated by acquisitions? You never really see. You never really see if they've worked out, because out on comes another acquisition, which
Yeah.
masks the acquisition before. So you're never entirely sure, unless the acquisitions stop for a couple of years, you're never sure how things are playing out. This happens with Unilever at the extreme end. Unilever has made loads of acquisitions, and many of which have been absolute dogs. They don't tell you about those, not until a lot later. I just think it's amazing. A business like Unilever, it's more extreme because they must have some incredibly bright people that could innovate and bring loads of organic growth if you gave them the freedom to do it. Just like these excellent engineers.
I'm not sure we mentioned it last week. Did we mention that Fabergé was part of the Unilever portfolio on the podcast?
Yeah.
I'm not sure we did we?
I'm not sure we did, but it used to be, yeah.
Yeah,
Fabergé, which was a jeweler, then became a cosmetics brand, and now is back to being a jeweler again. Yeah.
Yeah, an individual or the company that bought Fabergé paid peanuts, didn't they? They paid absolute peanuts for it off Unilever, and then subsequently sold it to
the listed company is Gemfields.
they sold it to Gemfields.
So it injected it into Gemfields for about 100 million, and it wasn't. They didn't buy it for anywhere near that. But Gemfields as well, yeah, it looks decent. The shares look decent value, but yeah, another bonkers acquisition of past times. But these businesses go through so many acquisitions. Unilever's ice cream business is now up for sale because it's not considered really relevant to its current means of distribution. Not sure it evidently ever was relevant. It seems to be on a very different platform, a distribution platform. But yeah, I don't. Sometimes you do wonder.
Yeah.
They're given a pot of money and the wherewithal, they just go wild on acquisitions.
Yeah, and a company as well that actually has done multiple acquisitions, but it's actually now cleaned itself up, hasn't it? And it's gone back to its core business, RBG Holdings.
Yeah, it did loads of acquisitions. The legal service, it was a litigation specialist, did a few acquisitions, and it's flogged the businesses that it acquired, one of which it's made a huge loss on, 13.5 million write-off of goodwill, an impairment. It's called non-cash, but it was cash at one point. They paid it out, but now it's non-cash that suddenly magically becomes non-cash. The loss they have sustained on this one deal is equivalent to the business's current market capitalization in its entirety, 13 odd million. But they're back to their core focus of legal services. They got a heap of debt, but maybe greater focus now in what they're good at. Hopefully they can rise again, but it looks very cheap on many levels, but the debt bit worries us a bit.
I think we've laboured the point around acquisitions and just making sure do they make sense. So shall we move on to a potential recovery play here in Frontier Developments? Is this a recovery play, Chris? Frontier Developments? Is it something that Fundamental hold shares in?
Yeah, the video game developer. It's another frustrating one. We've never held the shares, but I watch it with interest. We hold other video game developer that's somewhat better. They're all been under a cloud. We're no longer playing video games as everybody was in the pandemic. Poor old Frontier Developments. It does some really interesting things, but it's just, if you look at the cash flow that it's produced, it's negligible. It incurs so many costs, cash costs, to develop the games. But really, is it all coming back? It hasn't been up to now. And you can look over a long period on this, over 5 years. The free cash flow, that's the cash flow net of all the capital investment costs its business generated, it's only averaged £7.8 million per annum, which is peanuts relative to the sort of cash that's been flowing in and out of this thing. And I think it's a worry for the whole sector. Unless you get a mega hit, some of these video games are just deep holes for cash.
These games need to be a home run, don't they? And I see it with my children and their friends. They all congregate around the same sort of games. So I remember it was Minecraft.
Yeah.
Minecraft was the home run, shall we say.
Yeah.
And then it's
endured quite a lot as well. It's required maintenance, but that is still endured. Minecraft's still doing pretty well, isn't it?
Yeah,
Fortnite's still doing well.
I was just going to move on to Fortnite.
Really, yeah. The big hits are doing really well. Grand Theft Auto, whatever, they do well.
Yeah. But look at that. Here we are, two elderly gentlemen, older gentlemen, and even we can name off the hits, can't we? Yeah, and the amount of capital it takes to get to these sort of hits is quite intense, isn't it? It's an interesting...
It is. It consumes a lot of cash, and you've got to keep ploughing it in.
Of the hope of a home run. So we did say, didn't we, that we were going to finish off with a good company. Not that the companies we discussed are not good companies, far from it. They all are in their own right.
Yeah, there's some crackers in there, some good ones.
Yeah, there is. And these acquisitions, they may well work out. It might be just too early to say. I think
they might work out. Yeah. But I just think I think it'll be tough to tell. I really do. Because once you get in the habit of acquiring and your investor base is happy for you to keep acquiring, you just keep it going, keep them going.
Until eventually the emperor has no claws.
Absolutely.
Yeah. So let's finish off with James Latham.
Some people say it's a pretty boring company. It's a timber distributor. It's been around forever. It's been on the stock market for a long time. I think its origins go back to the 1800s. It's a terrific little business. The results as clean as anything, not an adjustment in sight. Great cash flow, did really well when clearly materials started soaring over the pandemic. And I think it's worth looking at. It rarely makes acquisitions. When it does, they're pretty well thought out. In quite a business in Belfast that gave it geographical reach in Northern Ireland. But for those looking for squeaky clean accounts, very prudent accounting, great cash flow, rock solid balance sheet, and for a timber merchant, the shares have done pretty well. You get a nice dividend, a growing dividend. I think it's ever missed its dividend. But yeah, it's a really high quality business, nice margins, and it ticks a lot of boxes. It's not going to excite everyone, but I think it serves as a lesson to many and is worth looking at for that reason.
It does Fundamental own them, or is it in any of the
Yeah, we've held shares in them for a long time. They're in our AIM portfolio, AIM IHT portfolio, the Fundamental portfolio, and I think it's seemingly a good, honest company.
So what might be the good lesson of this podcast is read the annual report for FUTR and read the annual report for James Latham, and you make the decision.
Yeah, absolutely. Sounds a good idea.
Should we leave it there?
Will do.
Yeah.
Oh, went through a lot there.
We did, as always. Great to talk to you again.
You as well. Look forward to it next week.
Well, that's it for today. Please subscribe for next week's episode as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.